This is Kurt Heisinger, accounting professor at Sierra College and author of Managerial Accounting. This video describes how to use differential analysis to decide whether to keep or drop a product line. And what we mean by product line is a group of related products. For example, we might be a high-tech company that produces laptop computers and desktop computers and tablets. Each of those would be considered to be a product line. And within those laptops, we would have different models. Within the desktop computers, we would have different models, and so on. As the products near the end of their life cycles, that is, not many people are buying them anymore, and new, more recent items are coming out, managers must decide whether to keep or to drop those product lines. And we do this on a continuous basis. We will continually assess whether to keep or discontinue our current product lines. Here's an example that we're going to take a look at on the next few slides. Let's assume that we are Barbeque Company and that we have three product lines. We have gas barbecues, we have charcoal barbecues, and then barbecue accessories. We are trying to figure out whether to keep or drop the charcoal barbecues. Perhaps they're getting toward the end of their life cycle, not that many people are buying them, and so we're trying to figure out, do we keep them or do we drop them? And we'll show this on the next slide, this decision that we have to make. So right in the middle of this slide is where you will see the decision that we are looking at. And we're going to use differential analysis to figure out whether to keep or to eliminate the charcoal barbecue product line. We're going to keep the gas barbecues and we're going to keep the accessories. Those aren't the issue right now. The issue is really with this right here, the charcoal barbecue. The information that you see here is related to alternative 1, and alternative 1 is simply to keep all product lines, to keep the gas barbecues, to keep the charcoal barbecues, and to keep the barbecue accessories. The total then is really what we're going to focus on, because we're going to compare this to what will happen if we drop the charcoal barbecue product line. We'll compare the total columns for that alternative with this alternative in a couple slides and determine which approach to take. What I want to point out here, though, before we move on, is that we have this line called, or two lines really, direct fixed costs and allocated fixed costs. The direct fixed costs, those are fixed costs that are directly linked to each product line, and if we remove that product line, those fixed costs will go away. The allocated fixed costs, and I'm going to circle the total amount, the allocated fixed costs are, let's say, at the corporate level, and those fixed costs will get allocated to whatever product lines we have. So if we get rid of a product line, the part of that $120,000 doesn't go away, it just gets reallocated to the other product lines. The other thing I want to point out here is that allocated fixed cost amount of $120,000 gets allocated based on revenue. In this example, it can be done in many different ways, but in this example, gets allocated based on revenue as a proportion of total revenue. So let me give you a quick example here. Revenue for the barbecue accessories is $60,000 and total revenue is $600,000. So 60 divided by 600 is 10%, and that 10% then is used to allocate the $120,000. So we're going to multiply that by $120,000. That comes from right up here, and that will give us the amount of fixed costs that are allocated to the barbecue accessories right here. So that's how, in these examples that you're going to see from here forward, that's how our allocated fixed costs are divvied out to each of the product lines. Okay, so here's alternative 2. And we're trying to figure out, if we drop the charcoal barbecue line, what will happen? Will our profits go up or will they go down? So which alternative is best, to keep the charcoal barbecues or to drop them? And you'll see here that the total, when compared with the previous slide, the total profit here is $189,000. It's important to point out that this $120,000 in total allocated fixed costs did not change. It just simply was allocated to the remaining two product lines. The next slide will show us then how the total profit here of $189,000 compares to the total profit with alternative 1 and keeping all of our product lines. We're trying to answer the question, What should we do as Barbecue Company with our product lines? Should we keep the charcoal barbecues or should we drop them? With alternative 1, keeping all product lines, we have profit of $199,000. With alternative 2, dropping the charcoal barbecues, we have profit of $189,000. So what you see here is that alternative 1 is higher by $10,000. So the decision for us as a company is to keep all the product lines. There are a couple of key points here related to the allocation of fixed costs. First of all, if a product line is eliminated, and you saw this in the previous slides, we talked about the possibility of eliminating the charcoal barbecue. If the product line is eliminated, our allocated costs are typically not eliminated. They just get reallocated to the other products. So if you go back a few slides, you'll see that it looked like our charcoal barbecue profit was actually a loss of $8,000. But when we eliminated that product line in alternative 2 in the previous slides, the allocated fixed cost just simply got reallocated elsewhere. So it really didn't help us. In fact, it hurt us to eliminate the charcoal barbecue product line. And so that's what you see here in the second bullet point, that we can see an increase in the allocation of fixed costs to other product lines, and it might even bring the profit into negative territory, into losses for other product lines if we're not careful, and we might start considering the elimination of those product lines. We have to be very careful with the allocation of fixed costs, knowing that in total those costs will remain the same regardless of the number of product lines that we carry. We also need to consider the possibility of having opportunity costs and what the impact might be of opportunity costs on our differential analysis. What is an opportunity cost? In technical terms, it's the benefit foregone when one alternative is selected over another. I like to put it in simple terms and say it's what we give up to get something else. Managers must often consider this impact when we're making decisions, and so I'm going to show you how to work that into the analysis on the next slide. If you go back a few slides, you'll notice that this column right here simply summarizes the differential amount column that you saw in the slide that compared alternative 1 with alternative 2, keeping all product lines versus dropping the charcoal barbecue product line. But what we've added here is one component that has to do with opportunity cost if we do have opportunity costs to consider. So if you recall, right here we determined that we would actually lose profit, we would actually reduce our profit if we dropped the charcoal barbecue product line by $10,000. Here we introduced the idea that, well, if we drop the charcoal barbecue product line, we can use that space or lease that space to somebody else for $25,000. That's the opportunity cost if we keep the charcoal barbecue product line. So we're working that into this analysis, and what you see is if we can lease that space for $25,000, but we lose $10,000 by dropping the charcoal barbecue, then we probably would opt to lease that space for $25,000 because it would result in profit actually going up $15,000. So that's how we work opportunity cost into the analysis. The last thing that we need to talk about is the concept of a sunk cost and how it might affect differential analysis. A sunk cost is a cost incurred in the past that cannot be changed. That's important, cannot be changed by a future decision. So as an example, let's say that we bought some specialized machinery, production machinery. Let's say we produce charcoal barbecues, and we bought some specialized production equipment to produce the charcoal barbecues. We've paid for it. We bought it 2 years ago. There are no costs going forward related to that production equipment. That's a sunk cost. So we really should not include that. It's not a differential cost as we decide whether to keep producing the charcoal barbecue or not. It's a sunk cost. So sunk costs are not differential costs and therefore are not typically included in differential analysis.